All right, let's get right to Bill Rodgers, Vice President and Director of the Institute for Economic Equity at the Federal Reserve Bank of St. Louis. Bill, always nice to get some time with you. Your take on the jobs report this morning.
Well, the payroll number clearly did not disappoint. February, we saw the nice, strong growth above what we were expecting. And then the previous months revised upwards. So that's good news. The other good news about it is that these increases in payroll seem to be supported by increases in participation. That is the labor force participation rate and also the employment population ratio. So that's a nice combine. The one concern I do have in it is the wage number, the year over number that the secretary talked about, the 5.1% increase. Compare it to what's been doing, what the CPI or Consumer Price Index has been doing, a little bit lower. So that's putting a pinch on families that are on fixed incomes, and then just in general, right? It's putting a pinch on people's disposable income because of their wage increases are being eroded by cost of living increases. But overall, for where we are in the recovery, nice strong number.
And I know, Bill, good morning, by the way, it's Julie here. I know that you focus on that you focus on equity in particular. And so we're hearing from economists that the reason that wage growth was flat over month was largely compositional effects. That is, more lower wage workers were added during the month, so you didn't necessarily get the lift in that number. What does that tell us about how lower wage workers, more diverse workers in some cases, are weathering this particular period of higher costs if they're not getting that wage growth?
Yeah, it's a challenge, and as you said, at the Institute for Economic Equity, we focus on the distributional issues. We focus on how the pie, so to speak, is being divided, and the way I guess I think about your question is we have to sort of step back to the conversation of where were we just before the pandemic started, right? A lot of folks thought we had the best economy since World War II, but at that time, prior to the pandemic, we had families who, if they had an unexpected bill of $400, couldn't make it. That was about 12% of, I think, households that were surveyed, and then that number is even higher if you include people who are having just difficulty meeting their pay. Wealth inequality was at an all-time high. There's a concept called ALICE, where ALICE stands for Asset Limited Income Constrained and Employed, that I helped United Way of Northern New Jersey create. And it's basically a living wage calculation. And in many communities, prior to the pandemic, you were looking at about 35, 36, 37% of households being at or below ALICE. That is not having enough resources or income to make ends meet. The pandemic then really exposed these fragilities amongst these families, particularly for women, particularly for families of color. And what's happened is all the groups took a major hit in their employment and wages, and if everybody has recovered. But the problem I have, or a concern I have, is we don't want to use pre-pandemic as our benchmark. Let's get back to the pre-pandemic level, because pre-pandemic level, the economy or many households were in fragile or very, month to month sort of movements or experiences in terms of, and then thus having the potential challenge of being resilient. So, it's great for us to get back to the pre-pandemic, but it also means that we need to look at a whole menu of choices or solutions that can help to restore resiliency, that can help to restore economic security in a broader based sense.
Despite the wage gains, Bill, over the past year, are these high levels of inflation pushing more families into poverty?
That's a great question. At this stage, we don't know just yet. But my intuition would be that that the sustained increases in cost of living, and particularly because they're broad based, it's not just energy. It's been childcare, it's healthcare, right? It's food and clothing. And so when those numbers do come out, we probably will see a potential uptick in poverty. But but the other thing is when I mentioned this concept called ALICE, right? ALICE includes people who are by definition from the government in poverty, but more importantly, it includes middle income families, right? And that's the big problem that the secretary, I think he alluded to, is that particularly because of the decline in unions and other practices, right? We've seen more middle income families, instead of their incomes and earnings tracking the top fifth of the economy of workers and families over the last few decades, their incomes have been tracking the bottom fifth of the wage ladder, and that's again what we are focusing on at the Institute, to try to help people understand that the pre-pandemic level is great to get us back, but it's not where we want to be.
And Bill, I'm curious too, when rates start to go higher, obviously inflation is pinching everyone, particularly these folks you're talking about. What will higher rates do? Because I should know this. I don't know what level of debt, for example, these folks carry. So what effect is that going to have?
When you're saying higher rates, higher interest rates?
Yes.
Yeah, that's the question why you're starting to move into FOMC policy, and I really need to sort of leave that to my bank president Jim Bullard and Mr. Powell, Chairman Powell, and his colleagues to really be able to answer that question best for you. But from our perspective, as Institute for Equity, we just published something we called the State of Economic Equity. It was a 6-blog series. And one of the big takeaways for us is that 2022 is going to be a period of transition, that we're thinking that the economy is going to stay strong enough to provide opportunity for those lower and middle income communities such that they can restore resiliency, they can restore their emergency savings, they can restore their wealth, their ability to access affordable housing. Because if we don't do these kind of reimagination approaches for helping families and communities, we're just setting ourselves up for the next shock, which could be another COVID-19. It could be a shock from abroad, but the bottom line is we can make the choices to do so, and that's what we're trying to do to help people understand those choices.